Welcome back to U.S. Farm Report. Okay, now that we understand what's going on with our stock market and China, what impact does it have on U.S. grains and oilseeds? Bill?
Well, I think it's positive, which is the opposite of, what all of us think. And the reason is this sell-off that we had has, for the first time in many, many years, really since 2006, this is the first time that on Thursday, the floor reported that the funds had a zero position in soybeans. And they were actually about neutral in wheat, and they're still long like 60,000 contracts of corn. Of course, this will all be verified by the CFTC.
Okay.
But I'm excited because with the funds out of the market, now the market is going to find its harvest low based on what the end user is willing to buy. Real demand, not demand that's on paper because of some investor who's inflating prices. And once we establish that low, I mean, all of us in the ag sector are going to know what risk is. We're going to know what the risk is for planting corn, paying rents, everything else. So I think we're going to hit real value without investor-inflated price built into it.
Based on real value, interesting. Mike, speaking of real value, and let's look at these prices. I mean, because we are seeing some of these demand issues possibly when we look at the world economic situation, does that really keep a lid on our prices moving forward?
We are reminded of the big supplies that are out there. International Grain Council came out this week and ultimately said we're looking at record supplies of grain moving forward into the next marketing year. That's a reality we have to work through. And as Bill pointed out, in our search for real value, the buyer is going to be slow to chase a market knowing that. And that's something that we're going to have to work through as we get into harvest. I think with all of this being said, we're probably looking at a natural seasonal tendency towards lower markets into fall, and coming out the backside of it, I think that's where we could really start to change the picture quite a bit. Bill pointed out the change in the fund position. I've been watching that like everybody else likely has. If they want to come back in as buyers, this has really opened the door for them to do that, and no better time than after a big wash off and a big sell off in the market to get back in, especially as we look at those seasonal opportunities for post-harvest rallies.
Bill, could we see a harvest or a post-harvest rally, considering everything else going on with the market? I mean, even if the yield isn't as good as what we think right now,
right.
Does that
and
move
I
prices?
think that's going to be the catalyst, whether we have a decent rally or not a decent rally. If yields are coming in significantly below 166, 165.9, that's kind of what we're trading right now. If we're really below that, then yes, we could have a significant rally of more than 40 cents. Otherwise, we're going to go into a trading range. We're going to go into what they call demand distribution, supply distribution.
And if we do end up going into that, Mike, I mean, what's your advice for farmers?
Well, I think the big thing you have to be looking at right now is managing basis. We haven't gotten into harvest yet, and for the most part, basis is decent. Let's just call it decent right now. But if we come in with another big crop like we're expecting, basis is going to get really ugly. So for farmers, I think they need to be capitalizing on basis opportunities, looking for these ranges to play out and opportunities to set price.
We talked about China earlier. We're not seeing a lot of our soybeans go there, but you say that doesn't mean they're not buying from other places.
No, last month they imported a record amount of beans. They imported 9 million tons. To put that into perspective, a couple of years ago, their port capacity was 7. So they've built new capacity and they're using it all, but we're not getting the business because of our dollar and everything else.
Switching gears a little bit, dairy. We've seen a huge disparity between U.S. dairy prices and international dairy prices. So what's going on, Mike?
Well, we had a domestic buyer that was spooked by the New Zealand drought earlier this year. They built private inventories, made a strong presence in domestic markets, and to this day carry a big premium over world prices. Butter is trading north of $1 over the world market. Cheese is trading 40 to 50 cents over the world market. Powder is our only market that's really on par with what you're seeing in world markets. But the reality is we have a growing inventory. July was a record inventory month for us, and growing production in the United States. That all has to come to a head at some point, and these softening economic markets create a little bit of a demand struggle for us looking forward.
Short term, higher or lower dairy prices?
Looking for lower prices into the fourth quarter and first half of 2016.
All right, we're going to get the closing thoughts when we come back, so don't go anywhere.